My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey folks, a lot of us have the aspiration that when we grow up, we want to be purely passive investors in real estate. We don't have to want to be finding the deals. We don't want to have to be completely underwriting deals from scratch. We don't want to have to be raising capital and then dealing with administration and dealing with the tenants and toilets that come along with multifamily deals. A lot of us want to become purely passive investors. And today's special guest, zooming in from Dallas, Texas, David Banks, does exactly that. For the last number of years, he has been an LP on a number of multifamily deals, as well as mobile home parks and other assets as well. So David, welcome to the show. Great to have you.
Thank you, Dave. I'm really happy to be here and looking forward to our conversation.
So David, I kind of set you up there. So give us a little snapshot of how many different deals are you currently involved in? What are the asset classes? Just give us a kind of a big picture overview of what you're into.
Sure. So we started out, backing up just a little bit, how we got to being passive investors. When I say passive investors, it's my wife who's my partner in our business, Addison Financial, which is based here in Dallas. And we started out actually as money lenders to house flippers and people who were buying rental properties. My original career was in technology. Like some of your other guests, I was in software sales and management for about 30 years. And then in long in about 2012, I started up a lending business, again, lending to house flippers and to renters or property owners for renters. And that business really got started because we were coming out of the Great Recession, great financial crisis, and money was harder to secure, especially for smaller operators. And so kind of found a business there. We had the capital.
Were you using your own funds, your own capital?
Yes. We are not capital raisers. We are not GPs. We were using our own capital, deploying that capital to these various people who needed these loans, and they tended to be smaller local operators who had a project. They maybe would go to a bank, couldn't get a loan for whatever reason, maybe not enough credit or good enough credit, or just a variety of reasons. Banks like to loan to people with a lot of money
who don't need money.
Yeah. And so our business was loaning to credit-worthy people who maybe already had a portfolio, had experience, maybe already had a portfolio of some homes, was trying to expand their portfolio, and just frankly, in these difficult times coming out of 2010, 11, 12, 13, needed capital. So that's how we got our start. Then over time, we decided we were either going to have to really scale that business, hire people, and really, if we wanted to continue to grow and compete with all the other companies that were coming into that market. Well, and so we made the decision. No, we didn't want to do that.
What year was that, David?
That was 2019, and so
you had about 5 or 6 years actively doing the lending.
Yes. And being able to keep it down to a 2-person company with our, with help from our accountant and that kind of thing. But we decided, okay, we're in a fork in the road. Do we want to really go out and build a business and have employees and do all that nightmare stuff, or do we want to find another path? And we chose the path. I was approaching retirement from software sales, and I don't like the word retirement. I use the word doing something else. And we decided that let's go out and look at some other asset classes. Let's be the passive investors. We never wanted to own rental properties ourselves. It's kind of funny. We loan money to people who do that, but we don't want to be the homeowners. Fortunately, we've never had to take back a house. We've never had to foreclose on anybody. So from that,
you like the passive side of things. Not that lending was passive because you had to vet your
Yes, correct.
borrowers and all that kind of
Yes.
stuff. Once it was up and going, you did not be involved in the nitty gritty of the deals.
Exactly. They were the ones that were buying the house, managing the house, fixing up the house. We were the lower money with a lien on the asset. So we decided, okay, we're not going to go off and build a big giant business. Very thankful looking back on it that we made that decision not to do that, and went more down the path of passive investing. And we targeted really three asset classes: multifamily apartments, mobile home parks, and then also kind of our bread and butter, private debt or private lending. And so investing with other companies who were deploying our investment.
See. What you've been doing before, but investing in other companies that are actively doing that.
Yes, because they're doing it at scale. They have the employees, they have the systems, all the things we didn't want to do. So we've invested with some of those types of organizations. And so it's been quite a journey. We've gone through the trials and tribulations of the multifamily. Unfortunately, we came into it about 2019 when everybody else did. And we've not.
It was pretty good for a few years.
It was good for a few years, right?
Yeah.
And fortunately, we have not lost any capital on any of the multifamily projects yet. And we really haven't even had a capital call yet. But a lot of these are not producing cash flow or distributions for us right now. And there was a lot learned from that as an LP investor. I think number one, go out and make sure and get yourself educated, because right now we're at and you've talked about this in some of your other podcasts, we're kind of at a place right now where there aren't a lot of deals happening. Buyers and sellers are still kind of disconnected. And I do think that that's going to turn around over time. But there's still some, and particularly here in Texas, although the economy's booming and we've been doing really well, the truth is we've had a lot of supply come online. And in the case, like one of our investments in Austin, for instance, that area, we've seen rents drop 10 to 15%. And that's a far cry from the go-go years of 2019, 2020, when we were able to raise rents 10%.
So how many different, sorry for interrupting, David, how many different deals have you invested in as LPs since 2019?
So we've invested in about 20 deals. We've got about $2 million in capital deployed into those deals.
Are you still investing in those 20 deals, or are some of them gone full cycle?
We're still invested in all those deals. Some of those deals are also mobile home parks too.
Right. So what percentage of your portfolio is multifamily versus mobile home parks?
Good question. About 31% is hard money lending. 44% is multifamily, and mobile home parks makes up 25%.
Okay, so you got kind
of a balance, a diversification. We don't want to be invested in too heavily in any one sponsor or any one asset class. So we went into this not just doing multifamily, but also wanting to kind of spread the capital out a little bit.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So it's always 20/20 hindsight, David. So knowing what you know now, and I know you work a lot with other LPs and people kind of getting into the space, what advice would you give to somebody who's thinking about getting into multifamily syndication in 2025?
Yeah, I think like we were just starting to talk about, first of all, get educated. Now is the time to do that, and really pick an asset class, drill into it. I've attended a lot of courses, gone to a lot of conferences, and networked with a lot of smart people to understand how to evaluate a deal in a multifamily or a mobile home park space. I took Frank and Dave's mobile home park 2-day immersion class. Way more than I'll ever need to know about mobile home parks, quite frankly, but definitely a lot of information.
Well, and then that way now you could look at a mobile home park pro forma and understand what it's all about.
Exactly. And there's a lot of nuances there. You just, you don't think about.
Yeah.
So get yourself educated. Also, come to understand that the pro forma is never correct that you get from anybody. It's either way off in the wrong way or way off in a good way. So don't expect that they're going to land. The pro forma is simply just a guesstimate of what they hope happens. Also, be just very, I hate to use the word, somewhat cynical about the numbers. Look at what they're projecting in the pro forma for rent growth. Today I'd better see rent growth of at least 3%. Expense growth, preferably in the 3 to 4%. If I see somebody, trying to show me they're going to grow rents 5% in an environment where rents aren't growing right now, or I'm talking about multifamily, or expenses are somehow going to be maintained at 2% in an environment where, frankly, inflation now is running right now about 3%. I'm going to discount that I won't spend much more time evaluating it. So understand, don't really trust what the pro forma has to say, and then also look at the track record. That I think we've taken one lesson away from what's happened the last 3 years with a lot of these types of passive investments is that a lot of people, as you talked about, jumped into this to become syndicators or operators, and a lot of those people are washing out. In the process of washing out, have washed out. So it's really, in retrospect now, the lesson of, do they have a 10-year track record? Have they been through the hard times? Somebody coming out of one of the guru classes with 1 or 2 years of experience, that's not going to be someone who we invest in. We'll keep an eye on them over the next few years, but we're not going to deploy a couple $100,000 to somebody that took a guru class and is now.
Well, I was going to ask you about that, David, because I know a lot of people that take the guru classes, one of the things the gurus sometimes sell them on is, hey, you can use my name as one of your advisors and blah, blah, blah. So it gives them kind of they get to borrow the credibility of the guy or gal they learned from.
Mm-hmm.
When that person's, well, hell, some of the gurus are in trouble these days, to be perfect.
Yes, that's correct.
So, what's your take on that?
Frankly, when I see that, and that's the way they're marketing themselves, that's, to me, at a minimum, a yellow flag, maybe a red flag. Yeah. Because again, it comes back to experience. How many properties have you gone full cycle on, right? Have you ever had a capital call? Have you ever, God forbid, lost LP's capital? So those things are more important to me, and having those conversations and understanding their level of transparency. Everybody's very transparent when they're looking to get your check, but keeping up that transparency is a whole nother thing.
Yeah. That is so true, David. Those are wise words, and obviously you've learned that the hard way. So, what are you and your wife, your partner, planning to do over the next year or two with your investing business?
We're going to continue on. I am, despite some of the negativity we've talked about in the multifamily space and some of the passive investments, I'm still optimistic. I do think over time, some of these situations are going to work themselves out. I've seen a lot of my LP network friends drop out of doing this and going back to investing in stocks and bonds and other things, or crypto. But I'm keeping an eye on the market. I'm still looking at the pitch decks. I'm looking for opportunities. We got capital to deploy in multifamily. And particularly in Texas, we prefer to invest in Texas. It's the market we know. And that's my other word of advice is don't spread yourself out across multiple markets that you don't know. I made that mistake. I invested in a mobile home park in upstate New York. Wish I hadn't done that because I don't know anything about New York. Some of the things they told me were that wouldn't happen did happen during COVID, such as trying to be able to evict people who were not paying rent and all that. Took a lot longer in New York, about 90 days versus North Carolina, where we have an investment in a mobile home park that takes 15 days. So you know your market. We're really focused on Texas. My wife is from Dallas, and we know the Austin, Houston, Dallas markets. So it's a lot easier for us to evaluate deals. We got a network of people we know here we can talk to about them. So my other word of advice is figure out the market you want to be in, know it well, and approach it that way. So to answer your question, we're going to continue to invest in these assets long term, looking for other multifamily projects. We'll continue to invest in debt funds, and we may do some more mobile home parks with time also.
That is awesome, David. Well, thank you so much for sharing your experience, the good, the bad, the ugly, right? And hopefully these deals turn around. I think a lot of them will over the next little while if you're with good operators who have a track record. And I think you're right. I think it's getting back to good old Warren Buffett, right? Be fearful when others are greedy and greedy when others are fearful. And everybody's fearful right now. Like
right.
So many LPs are getting out of it. In my mind, that's a good time to be looking at getting into it, especially if you're taking your advice and really looking at the fundamentals, really looking at the track record of the people that you're going to be investing with and going in with your eyes wide open, because it's really, in my opinion, it's getting back to the fundamentals.
You're 100% correct. We got away from those fundamentals, and it's so easy during the go-go years to get caught up in that. And one of the other things was how quickly these properties, particularly in multifamily, could be flipped, right? We had seeing operators flipping in 2 to 3 years.
You're not supposed to be flipping multifamily in 2 years.
Yeah. So get back to the fact that real estate is a slow way to develop wealth. It's a great way to develop wealth, but it doesn't happen overnight. Yeah. It's not crypto. And getting back to understanding, you invest in a multifamily property, you're probably going to be in it for at least 7 years, right? 5 to 7 years. Yeah. And don't be looking for a 2-year flip and getting hung up on the IRR and, all those mistakes were made. And despite that, we have still a lot of opportunities, some of our opportunities that are paying distributions and doing well. So not everything is bad. And if you look at the multifamily space right now too, absorption on these new apartments, all this supply coming online, it's good. It's very good. The new supply is getting absorbed. And I think probably if we can work through 2026, I think the extend and pretend that the banks are doing is going to come to an end, and I think we'll start to see some real daylight either toward the end of this year and going into next year in the multifamily space.
Yeah, it's exciting times.
Yeah,
David, I know we were talking a little bit before we started the recording, and you're not raising capital, you're not actively doing deals, you're a passive investor, you're an LP, but you love connecting with other LPs. You love connecting with, deal sponsors and looking at opportunities, especially if they're in Texas. So if people want to connect with you, what's the best way for them to do that?
Sure. There's 2 ways to do that. You can connect with me on LinkedIn at David L. Banks or at our company, Addison Financial, LLC. So LinkedIn's the best way to reach me. I'm not selling anything. I'm not raising money. I'm not a GP. I'm not a capital raiser of any sort. So I like connecting with other LPs, talking about opportunities, particularly as it relates to Texas. I also like meeting other GPs and syndicators too. So if you're interested in just talking and sharing ideas, notes, please reach out to me. Be happy to speak with you.
Awesome, David. Thanks so much for being on the show. This has been great.
Thank you, Dave. Enjoyed it.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.